Hello, everybody, and welcome to our webinar. Good morning, good afternoon, good evening, wherever we are from around the different parts of the world. It's great that you've all taken the time to be with us today for a fantastic webinar on impact investing. And I keep asking myself this question in a general sense around impact management, and we'll talk about all of the issues, but are we doing enough? And I think the question I keep asking friends and colleagues is, if not now, when? And by that, I mean very much, when are we going to create the changes in the world that are required? When are we going to create that level of positive impact that is absolutely crucial? And there's so much positive out there. There's so much great rhetoric. And it is about taking that rhetoric and making it a fantastic reality. And I'll introduce our fantastic speakers very shortly. But this is a part of a series of webinars brought to you by the Efiko.Academy and Social Value International. And we have some fantastic speakers today, and they join a fantastic group of people we've had in the past, some real thought leaders. And we're very, very lucky to have them with us today to share their experiences. So as we move on, please, to the next slide, we're talking very much about impact investing. And, like all good former academics, we should start with a bit of a definition. And we talk about it being, as you can see, the means to move capital to where it is needed, to create the effects, the positive social impacts that are required. But we have to ask ourselves that question again. The rhetoric is fantastic. There is some fantastic amounts of mobilization of capital. From the last count, I think the value was 715 billion US dollars per year. So the very purpose of impact management is to move that capital to where it is needed to create impact at scale. But the question is it really? Is it having the level of impact that is required? So how well are we doing? And that's very much where our speakers can come in today, helping us to understand where we are at the moment, our confidence going forwards, what still needs to change, and also the role that impact measurement and management can play. So a little bit about myself, I guess. I'm Adam Richards. There's my name, there's my face. I'm the Director of Impacts with Social Value International. I'm very, very fortunate to work with this organization. And we want to change the way the world and society account for value. And essentially what that means is through our international networks, we want to create those standards in collaboration with our members and with other parties, such as UNDP, OECD, and others in this amazing alphabet soup that we find ourselves, to set those global standards on how to do this, how to do impact measurement and management, how to account for social value. So please do have a look at the website. There's a recognized professional pathway there for individuals and for products and reports and so forth. And we have an amazing partnership and relationship with the Efiko.Academy. I'm very, very happy to be part of this relationship. And the Efiko.Academy, I think always I pause at this moment and say, well, what does Efiko mean? And Efiko is Esperanto for impact. It's the universal language. Impact measurement and management is a universal concern. And the Efiko.Academy is really setting the standard on the provision of training and support that is required to assist people to become impact professionals. We'll talk more about the offerings at the very end of our time together. But again, I strongly encourage people to have a look at the website and see how really practical, really interactive training provision is provided that really is tailored to the needs of different archetypes, be you an impact investor, a social entrepreneur, an NGO, or a corporate entity. So that's the bit of background about the organizations. And this, as I say, is part of a series of fantastic thought-provoking webinars. Probably shouldn't do too much about this because the bar was set so high. I know our current speakers will absolutely continue in the same vein. but very much moving from this idea of rhetoric to reality. We've had some fantastic speakers. We've had a focus on the need to listen to marginalized voices, that piece about involving stakeholders, listening to their voice and actively building it into decision making. But our speakers today, we are very, very fortunate to have both Stephen and Stephanie with us. I'm sure you know of them, but I will do my best to give a brief introduction. Stephen is the current chair and former chief executive of EVPA, European Venture Philanthropy Association. And Stephen wears many hats. He has worked for at least 15 years to support social purpose organizations to create impact at scale, but also works with corporates, particularly at the executive level, to help them move their strategies towards more inclusive approaches to business. Stephen is an active impact investor himself, chair of other impact funds, but really works to identify that sweet spot. I think that's what Stephen talks about, the sweet spot of where business and doing good can come together. A fantastic person to have with us today, a wealth of experience. And Stephen, thank you ever so much for joining us. We also have Stephanie, and Stephanie is, we were just discussing, Stephanie is in a transition point of career, but Stephanie was the former head of impact management at Bridges Fund and was responsible for delivering the impact management strategy, again, to support those ideas around a more inclusive and sustainable economy. I think it was back in 2016, Stephanie, correct me if I'm wrong, you were seconded to Impact Management Project, and you are one of the founders of IMP, Impact Management Project, which I'm sure most of us are familiar with, really helping to drive the standards, really bringing together over 1,000 organizations, probably over 2,000 organizations, to create growing consensus around impact norms and those real fundamentals of what impact measurement and management really means. And that continues to shape the evolution of this movement that we are all a part of. That's it from me. My job from now on, this point becomes so easy. I ask some questions to our speakers. They will do all the hard work. Please do contribute as we go through this. Please do add your questions into the chat. We will definitely have time for an open Q&A towards the end. And if you wish, I will happily give you the floor to ask your question directly to Stephanie and or Stephen. So that's it from me, other than to say, once again, thank you. Stephen, Stephanie, amazing to have you with us today. And first of all, I turn to Stephen. And I ask you a bit of an open question, Stephen, that goes, where are we? Where are we up to? What is the state of play with impact investing? To you, Stephen.
Thanks, Adam. And hello, everyone. And I hope you can hear me because I'm talking from a very rainy and windy day in Amsterdam. It's even hailing outside on the window. So I hope you can clearly hear me. But thanks, Efiko and Social Value for organizing this amazing webinars. And actually, as I shared with you, Adam, just prior to this call, it was for me as well a good moment to sit back and reflect, where are we on impact investing? And when I go back 10 years ago, when I embarked on this journey, it was rather a leap of belief. It was something you kind of were hopeful and you were thinking, if this would materialize, it would be great. And if you take it from that perspective, we have been traveling an amazing journey. Some of you might have been reading certain articles that were published recently, that this space is growing, and you mentioned the figure, whether it's 1 trillion or 2 trillion, it doesn't matter. It has been growing tremendously. Now, when I reflect, and I'd like to give a little bit of a mixed view, and I'm going to be quite brief on 4 topics, and we can dive into them later on. I'm very keen to also have your perspective, Stephanie. But, you know, at EVPA, in order to better understand the space, we kind of define the investing for impact and the investing with impact. Not to oppose those 2 areas. They are very complementary. They even overlap, and that's fine. That's great. Sometimes it's a blurred space, which is also fine. But in order to address the challenges, I think it would be good to quickly align and sharpen our view on this broad spectrum of impact investing. When we say investing for impact, in fact, we define all the initiatives that as a first objective want to realize societal impact, environmental, social, ethical impact. And the financial instrument is a mean to an end, which it's a grant, whether it's a loan, whether it's equity, it's a mean to an end, which is slightly different than an investing with impact environment where financial return, of course, risk-adjusted financial returns, or a fiduciary duty, and where impact gradually comes into play, sometimes as an equal portion, sometimes just as a risk avoidance portion. And if I take those different spaces for just 1 minute and highlight the 4 challenges I see, is in the space of investing for impact, I think we have to reconsider the metric of success. EVPA recently calculated this space, and the space is around 6, maybe 7 billion in Europe, which is of course 1/10 of the investing with impact space. But is size the right metric for this space? I don't think so. I think it's the way we unearth and also clearly show how social innovations can be stabilized, can be detected, and can be brought forward. So I think we should put much more attention in this investing for impact space in how successful are we in finding social innovations that can move to the next stage. And what I find being active in that space as well is that there is too little collaboration, because it's not so much in scaling an individual innovation, it's more scaling sectors. And so the challenge for me in investing for impact is how can we scale entire sectors? We did so with microfinance, we did so with renewable energy, but there are a couple of sectors like employment, like health, preventive health, that are ready to scale, and we should first start with social innovations. That's one. Second, in the investing with impact, again, coming back to the numbers, whether it's 1 trillion or 2 trillion, their size does matter, because we count on those actors in order to scale our social innovations. Now, this sector is, if you compare it to total assets under management, which is 100 to 150 trillion, it's barely 1%. And we've seen recently some articles that talk about what we call this deadly distraction, because we think we're on the right track, because we are growing as a sector, but in the end we have to be realistic. It's maybe 1% of total assets under management. And ESG, I do not consider ESG as impact investing. ESG for me is just plain risk management in today's times. And there, I think the big challenge, next to standardization, transparency, maybe even one day we would invite external validation to come in order to be honest about our impact. There, the main challenge is that we have to make sure that our regulation, our government bodies redefine the play at stake. What I mean by that is that I don't think in this space individual actors, even the KKRs and the BlackRocks of the world, will change this world, because they're all on a transactional journey. They all try to incorporate societal impact, but at the same time, the size and the speed is just too small compared to the challenges we're facing. So we need someone who truly redefines the playground, who's truly a game changer. And I think, and maybe that's a bit controversial and anti-Anglo-Saxon, but I think here is where government should come in and redefine the playground in order to have this paradigm shift. A third challenge we have is, I would say, that we should much better work together across the spectrum of capital. investors with impact, investors for impact, just by themselves will not change the game. Once the playground has been redefined by government, there as well, other actors should come in across the spectrum with concepts like blended finance. And there specifically, I would say foundations with their risk-tolerant capital should do much more today in order to help others to scale. And also public and semi-public actors like the DFIs should be more courageous and more bold to provide guarantees and first loss to kind of catalyze the commercial money. And the last challenge I'd like to share is it's kind of plea for a more sophisticated and a better understanding of this matching question between supply and demand. Horses for courses. There again, a recent article by Bridgespan, quoting the CEO of Senyard, was clearly stating that we have to accept to a certain level that the risk-adjusted market returns are not the only tool and not the only way to address social challenges. There are a vast number of social challenges that will never be able to be addressed with commercial money. If you take home violence, this time of COVID, it's for sure that commercial money alone will never be able to address home violence. So we need grant money for certain social challenges. We need investors for impact for other social challenges, early stage. We need investors with impact for more mature social challenges. And certain types of challenges will need different types of blended finance. So a better understanding of what type of money for what social cause will leave less frustration both with investors who always are looking for the right social cause and social entrepreneurs that are always looking for the right type of money, but they still do not seem to find each other. I'm going to stop here, but these for me are the four kind of reflections I was coming up with. David, Adam.
Thank you very much. I always take notes as we go through these and try and provide a bit of a summary at the end, and some great phrases there I think we can all take to heart. Stephanie, to you next. Yeah, thinking very much around what Stephen was saying, but thinking around what is the potential of impact investing, and maybe bringing in another question that goes, what still needs to change from your perspective?
Thank you, Adam. Yes, so where are we? What's the potential? So I'd like to be an optimist, also because the past year for all of us has been, rather challenging, I'm sure. I like to see the glass half full. I acknowledge, as Stephen also managed to say and illustrate, this is of course still quite a small movement, right? So I think globally we have currently assets under management of amounting to 150 trillion US, of which not even 1% could be labeled sustainable. So of course there's more to be done in order to reach scale. And I think we would all acknowledge that there are very many challenges that are highly investable. I think where we are right now, it's kind of a really interesting time in history, because we've also seen this at Bridges when we started out in 2002, so 20 years ago, when everyone's like, well, you guys are tree huggers, you'll never succeed. And now we're really at a tipping point, and a couple of really positive things and kind of trends which I think illustrate this potential. So first of all, you see that investing for impact is really going mainstream. What I mean by that is it's actually kind of a norm by now that ESG risk management becomes is a norm. So you don't only talk about the very specific sustainably themed investment funds, but actually all the big players now have moved into that part of our world, and this movement is becoming more prominent. And I think ESG and impact are merging more and more, and that's super exciting, because you do need both. You need to risk, you need to de-risk your investments, you need to manage your negative effects, And only when you do that, you can actually really, fast forward and reach full potential by focusing on positive change, positive social and environmental change. So I think that's kind of the first trend that we're seeing. And ultimately that helps because, traditional funds coming in like the KKRs or the Bains and the TPGs of this world really bring scale and prominence. So that's something that we need. The industry is also moving much more closer in terms of norms and standards, as you mentioned, Adam. I mean, of course, we are, I'm a founding member of the Impact Management Project. So I think for us, it was extremely important to kind of make sense of this alphabet soup of responsible investing, sustainable investing, ESG integration, and whatnot. But really trying to help all of us, all the different players in the industry, to really describe our effects. As a result of it, also help them measure and also manage and report this much more effectively. And there are like very many of these initiatives out there that are excellent, such as the impact weighted accounts, but also other organizations that are sitting outside of it. So the reporting bodies, the IFRS, the CFA, everyone kind of getting involved. And I think that's extremely encouraging because you suddenly see that impact isn't managed just in its isolation, but actually you need to optimize it as part of also your commercial due diligence. And this is exactly happening. And this is kind of the potential of actually making better investments by bringing the commercial and the impact side together. I think there's also more regulation coming at us, right? So I think couple of years ago, it was still fine to kind of slap a sustainable development goal icon on your annual report, and you would be a really fantastic sustainable investor. I think this is becoming much more rigorous, and I think we really all should welcome it. Of course, it means more resources that you need in order to report, for example, following the TCFDs, so the Task Force for Climate-Related Financial Disclosure, or the European SFDR, the Sustainable Financial Directive. And so I think, whilst this means potentially more work, it also means less greenwashing and more transparency. And ultimately, as all good things, we also need technology, and this is obviously on the rise. But you really see this in particular now also where, for example, Bridges is playing in the private markets, the rise of digital funds. And as a result of it, this is a really interesting trend because it really changes the access to the investor base. And this one is really changing. So, it's no longer old money. It's no longer institutional money. It's actually millennials, women that are investing and have access to these products. And they ask for accountability and really focus on that social environmental aspect, to not just be a narrative, but to be actually a value driver. So I think that is those are kind of the trends that we're seeing. I think there's a tipping point as a result of it. I think there's huge potential. I think in particular, there is obviously something that can be done on the scale, but more importantly, I think we can all do something in order to drive change, right? I think it's not necessarily needed that we are only focusing on the most difficult societal and pressing environmental challenges. It is also enough to focus on some of the assets that are doing bad and start thinking about avoiding harm and minimize our negative effects. So I think there's really plenty to do in this 150 trillion USD of assets under management globally, and each of us can do something on it.
Thank you very much indeed, Stephanie. So yeah, I think I like that point very much about we can all do something, shifting from doing to avoiding harm, as well as thinking about, I remember the ABC about, benefiting stakeholders, as well as working towards contributing to solutions. I think we're already talking about some of those points, but I think, you both raised the risks of current impact reporting, if you like, and you spoke about greenwashing. I think we should throw impact washing and SDG washing into the ring as well. And that's perhaps one of the, it's been identified as one of the biggest challenges I think it was the single biggest risk highlighted in the global survey of impact investors last year. So perhaps, Stephen, to what extent do you see that as a risk, I guess, the impact washing, let's call it, and how can we work to address that challenge?
Thanks, Adam. I think it's a risk for sure. I don't think it's the biggest risk. It's the biggest risk for the impact space. But again, the impact space today is 1% of the total assets under management. So we have to put it in perspective. And I'm also an optimist by nature, Stephanie. So I always also look at the bright side, and I'm hopeful at the same time. But if you just consider, and I'll come back to your question in a minute, Adam, if we just consider the urgency, I think the speed and the amount of money that's coming into this space is just too slow and too little. And I think the space itself, by organic growth and bringing in more people, will not do the trick. That's why I come back to the fact that we need pressure points, we need this sense of urgency so that also regulation will change. And when you say regulation, that's where your question comes in indeed, Adam. I think there is great work by IMP and others that are laying the ground floor for standardization, laying the ground floor for transparency. Even some start to invite external validation for their societal metrics. So I think that's all great, but I see it as groundwork. The big shift will not come from measuring all of that. The big shift will come from redefining the playground, redefining the game and the rules of the game. And then, of course, having clear rules should be helpful. So I see everything we do around reporting and management as a good preparatory work together. On investing for impact, I have a slightly different opinion on measurement, but maybe, Adam, we can go there later. But yeah, there I think we should take a different look at impact management and measurement.
Thank you very much, Stephen. And back to Stephanie then, you talk about the two sides of a coin, perhaps, or maybe minimizing the negative impacts, but also you spoke about optimizing the positive impacts. So how do those that wish to do that, particularly the optimizing, I think from what I hear and see, the minimizing the negative, yes, that makes sense, but then the optimizing the positive, how do we support people? How do we encourage people to have that sort of mindset? Is it there at the moment, and what's required?
That's a great question. So I think first and foremost, you need to think about impact being actually a science. And I think, everyone that is probably connected would agree with that, but it's not obvious. And we need to treat it as such. And as a result of it, I think we need to mirror the work that is done on the commercial side of things. Whenever we look at businesses, whenever we think about making an investment, that we also optimize and consider the social environmental variables as part of that. And so I think that, the biggest question we kind of need to ask ourselves, in particular when you're thinking about how do you drive positive change, is why you want to do it. I mean, of course, there might be, a kind of a moral or ethical kind of desire to do this. But I think in the investment space, at least the work I've done to date, there is really the belief that this creates value and that these businesses perform better. I think there's plenty of evidence already on public assets. So it depends also a little bit by asset class. On the private market side, you have the same thing. And as a result of it, I think you really want to, you kind of want to start at the beginning, which is essentially why we're doing this. And if the answer is because we want to create value, then I think you just, you need some standard and norms. You need to start thinking about the goal that you want to achieve. Based off that, you want to set certain targets. Based off that, potentially you highly likely want to measure this. And as a result of it, you want to treat it similar to, you know, the commercial side of things and the ongoing monitoring you're doing there, and kind of manage that and monitor it and try to understand based off data how you can improve. And so I think that's essentially required. So it's not only a risk mitigation game, it is really thinking about how can you optimize, including these social environmental variables in your pricing, and how can you drive change working with portfolio companies. Where are we there right now? Well, I think, you know, one could possibly claim that everyone that is an impact or a social sustainable investment fund, probably we could all agree that the impact that we're having is probably overclaimed. But I do think that, you know, we're getting somewhere where people really understand that this is a science, and where people understand that there's value in not only screening, but also post-investment, that there is really value that drives operational excellence. That is, you know, money that you leave otherwise on the table.
Adam, could I quickly react to make it a bit
Please do, Stephen.
lively?
Please do.
I think Stephanie gave just great input. From a science, I tend to agree, Stephanie, but I think it's also by just learning, and most of you know I'm an investor as well. I see a difference between a collective aspiration and an individual transaction. Give you just an example of last week. I'm sitting here in Amsterdam, and there is a village here in Amsterdam where the Green Liberal Leftist Party has by far the majority of the vote. Now there was a row because they wanted to have windmills. The government, the local government that won the election said, okay, if I have this kind of constituency, this kind of community voting for me, I'm going to put windmills and solar panels, etc., etc. Now what happened is that every people said thumbs up, but not in my backyard. And recently, again, in the Stanford Social Innovation Review, I started off with corporates, and corporates should embrace sustainability because sustainability creates value. Again, another article, complicity of corporate sustainability. I'm expecting that if we are not careful, we're going to have a backlash on us by the 95 or the 98% that are just kind of adopting ESG, but not creating positive social impact. And that's why I'm saying that on an individual transactional level, when you're dealing with day-to-day shorter-term objectives, it's very hard to kind of invest in much longer term. And that's where I think players like movements, like governments, should come in to redefine the playground. No big social change ever happened, whether it's women's rights, whether it's sugar-free diets, whether it's child labor, ever came by the people that were acting on a transactional short-term base. They can kind of prepare the playground, and they should be ready when this tipping point happens, but the big change comes from movements or public actors.
Thank you very much. My job gets even easier now, if that was at all possible, as I turn to our audience, and questions are coming in. Please do continue to send them in via chat. What I would like to do now is, first of all, to turn to Deb from Advent. Deb, you have a question, please.
Yeah, thanks. Can you hear me okay?
Perfectly.
Okay, super. So my question was for Stephanie, but obviously, Stephen, also keen to hear your thoughts and everyone else's, and thanks for the time. But, you know, as you were mentioning, KKR, Bain Capital, all of these large players entering the impact space, super important, right? Because it brings, it just, the more momentum we have, I guess, the merrier. There's enough money in the street right now whereby there's space for everyone. So I definitely see the benefits, and I think it's a great development. But I would love to hear from you what you think about the way they approach it, right? The way I understand is that they typically it's a very similar fund to their other funds, but they tend to link to the SDGs, for instance. And that's just one of the way they define, right? I'm not sure how they're measuring, but I'd love to hear from you whether there a bit of a discount on the impact in order to meet their expectations that these guys have on the return side, and if there's a discount on the return side in order to, you know, take impact into the equation, or if they are really managing to find the synergies between both, which is what I think people like you and I have been looking for, opportunities that do exactly that. But there might be also other great opportunities that, you know, might need a discount on one side or another. So we'd love to hear your thoughts on that.
Hey, that's a great, I mean, it's a super complex question, right? So I think my view in this is I really welcome all these players coming in. I think it's great. I think this is exactly what the industry needs, because you can't just have a few players that don't have competition. You actually need, you know, the big guys come in and ultimately have capital flow. Now, I think your question on, you know, are they doing this most effectively? It depends a little bit on their mission, right? It depends also where you sit on the spectrum of the impact economy. Do you want to do field building where you're okay to have flexible financial returns? Do you want to do responsible investing, which is essentially just ESG risk management to protect value? Do you want to be a sustainable player, which means basically creating value through progressive ESG, or you want to do impact? So I think it all depends a little bit where these, you know, what's the mission of these different funds. So I think it's hard to kind of say they're doing well or they're not doing well. I think my position is that also from the work that we have done at Bridges across the spectrum of capital, and we have, you know, multiple funds and multiple strategies spanning across the spectrum, you can have social and environmental, positive social environmental returns whilst also having market rate returns. So I'm a really strong believer of that, and given that these are excellent investment houses, I would hope they will be able to replicate this. I think that the only thing that I would say, which I find probably isn't that easy, is when you have a traditional fund that essentially runs on the basis of we ignore the social environmental side. It isn't part of our equation. And then you launch an impact fund or an impact arm within your set of funds. I do think that is complicated, in particular when you co-invest. So I think that for me is the only thing that, you know, they also are very transparent about this, being like, yeah, it is extremely hard to manage and manage those expectations of investors. But I do think that kind of holistic approaches, such as, for example, I think Carlyle, the road that Carlyle has chosen to go down, which is essentially we start being really good at ESG, and based on that we might launch certain products. For example, makes more sense from my perspective in terms of growing it organically. But I think it's kind of hard otherwise to say, you know, they're doing well, they're not doing well.
You might imagine I have maybe more nuanced view on what those guys are doing. And that's where I like very much the title of the seminar. It's good, but it's not good enough. What I mean by that is that I see ESG very clearly as a plain risk mitigation program, which they've been doing for a long time and which they should do for their fiduciary duty, for stranded asset reasons and many more reasons. But what I think is, if we focus too much on what these type of guys are doing and what is called this deadly distraction, is that we leave tremendous social challenges unaddressed. If you know that from the whole impact investing space in India, 50% goes to financial inclusion. Only 4 to 5% goes to agriculture and education. But the big challenges do go to those areas. So focusing too much on what those guys are doing, which is good, we should not expect that they will change the whole game and they will solve all social challenges, because certain challenges they will never address because it's too early days, too risky for them. And other challenges, social challenges, commercial money should never address. And again, that's where I'm coming back, where or blended finance or other types of money, both capital money from corporate, from foundations or public players should come in to have a more holistic approach to address all those different social challenges. One last example, they're keen to invest in renewable energy since a couple of years, but green energy has been there for 30 years. So it first was funded by different types of money. What about biodiversity? None of those big investors are investing in biodiversity because it's too early stage. And will the market ever address biodiversity? So it's good, it's great. I applaud it, but it's not good enough.
Thank you, Stephen. I turn to Carl from Humanly. Carl.
Yeah, good morning, folks. How are you? Yeah, just a couple of questions, and I suppose, look, I'm new to this space, so they're maybe a bit general. So I just wanted to ask Stephen, like he made a comment that there is only a tiny, there's 1% of investment goes into the social impact space. Like, why does he think that is? Like, why after, even though you've said there's so much progress and this is going on quite a while, there's still only 1%? And I know that's probably not a simple question to answer, but just I'd be interested in his comments on that.
Because a couple of things. First of all, that's a long-term change. The DNA of the asset managers that are managing those funds still come from the old days. And the metrics they're using, the reward system they're using, the philosophy and the DNA is still very much old days. On top, there is this fiduciary duty, and we can redefine this fiduciary duty, and I think we should redefine it. But their financial return, that's what they do care about. That's what is front and center for them. And if you talk behind the screens with those guys, they compare each other very much on what return do you provide for what kind of investment. So most of them see the whole impact space as a risk mitigation strategy. And that's where I agree with Stephanie, we should go to the next level. It is how to create impact additionality, how to create positive change rather than mitigating negative impact. And that 1% is on the positive impact creation. So there are many more that are trying to kind of mitigate negative impact, but the 1% is on the positive impact.
Okay. Okay, yeah, thanks. And can I just ask Stephanie, she mentioned about we all doing a piece, that everybody should do a bit. So I was just saying to Adam there in the chat, what about groups like Efiko? And there's 50 odd people on here. Is there anything people like us can do as a unified group of people, do you think?
Yeah, for sure. I mean, I think, look, I think having Efiko and kind of a group of people that is studying these different principles that are out there, I think this ultimately means there's a huge potential to actually change and improve, right? Because I think there are a lot of initiatives out there where people think about, how can we as investors put together a couple of principles that would work? You can do the same thing as an enterprise, same thing as a community or as a consumer as well. And I think, even a starting point would be even turn to pension provider and ask him or her what's going on in the market and how your money gets invested. So I think there are quite a lot of things that we can all do, but it's, as said, it's an old practice. Sustainability is an old practice, but it's a new science. So I think there is more that needs to be done to improve the theory and ultimately really help people understand whether you're an enterprise owner, whether you are an investor, or you're just a consumer of a product, to really help people understand how you can improve. And I think that's back to also your first question. I think the problem is the reason why we don't have capital flow that quickly is also, as Stephen was saying, there is in a way little understanding also across the investment value chain, right? the investor is really bad at actually describing the preferences that they have. And as Stephen was saying, currently they say, we really like this whole social environmental narrative that you're giving us, but actually, you know, what I care about is price. Or the returns that you're making, right? So I think it's potentially not always already baked in your fiduciary duty. But I think what it was also missing from the other players in that investment value chain, whether it's the enterprise, whether it's the investment manager, or the person that actually benefits from the product or the service, is to really talk the same language. It's like, what do we need? How do we manage it? As an enterprise, how do I think about not only shareholder value, but actually stakeholder value to, you know, build a more sustainable, more resilient, cyclical business? As an investment manager, how do I communicate these effects more clearly to our investor base and tell them what I am about to really differentiate? And I think that is something that has been missing. As I mentioned before, we had this massive alphabet soup. I think we're getting more clarity. There's also more regulation. And as a result of it, I think things might streamline and capital finally can flow to the right places, because people are better at describing their preferences and their needs.
Super. Okay, thank you.
Adam, could I add one thing, because I don't want to leave the audience, and I think, Carol, your question is very timely. I don't want to leave the audience with the idea that, okay, it's the bigger picture and system change should happen somewhere, and we are all waiting for whatever player comes in that will redefine the game, etc., etc. No, that's not my message. What I'm seeing this very much as an innovation trajectory, as a very major innovation that will happen in our society. And innovation is never linear, never ever. It's always exponential. And what we never know about innovation is, when will this tipping point happen? Will it happen next year? Will it happen within 5 years' time? There is time pressure and there are some urgent things to tackle, but we can't predict this tipping point. But the good thing about people that prepare for innovation, that are dealing with innovation, even at a small level, once the tipping point is there, they're ready to get the spike, they're ready to surf the wave, and they're ready to be at the front end. So I think all people around the table today, they're front runners. And sometimes it's exhausting to be a front runner. Sometimes it's frustrating to be a front runner, but we should keep on running this marathon, because the tipping point will come someday, somehow. And then we should be ready to scale.
Thank you very much indeed. We have got time for one final question, and I turn to Patrick for this.
Thank you very much. I love the discussion, first of all. Thank all of you. Some of the elements is interesting. We're saying, if we want to really change game, then should we not really move forward in making sure that externalities, and so negative impacts, are being costed and charged to those who have a business model that generate profits. And we're trying to do that, but shouldn't we move that much further? And should we not move then to the next stage and saying, actually, we expect organizations to generate positive impact. And if you don't do that, you have different tax levels, tax systems. I mean, if you're not generating positive impact in your business model, you pay more tax on your profit. So this kind of game changers we're talking about, Stephen, look interesting how we evolved to that. Then I was very interested in the discussion on how do we prepare the big change. So this paradigm shifts and the old school concept, how do we make sure that there are many more people who have different paradigms? So this work on, I think indeed with Efiko and with we ourselves with social value, different countries, social value networks are going to be important. Creating experts and teams in impact measurement and management across the board in all sectors, government, private, not-for-profit, etc. So these, how do we work and how do we move forward? and we create the pressure for the tipping point.
Yeah. I think, Patrick, the last thing you said is very important. I see 3 ingredients to make this successful. And the last thing indeed is what you mentioned is there should be sufficient pressure. If there's not sufficient pressure from the outside, nothing changes. That's just human. It's myself, it's all of us, that's human. Sufficient pressure points. That's where movements come in, activists come in, people that keep on pushing us and telling us, guys, it's 5 to 12 or 5 after 12. That's one ingredient. That is important. If there is sufficient pressure, then regulators start to redefine the playground, redefine the outcomes, redefine the value proposition, redefine what is success for a business, redefine what is success for an investment. That's where the new regulation comes in. And then our community comes in, not at that moment, but already for 10, 20 years, because then we should be ready to grasp the potential. Then we should not start to think, how are we going to deal with this new paradigm and how to deal with this regulation and those externalities if we make them internal by impact weighted accounts. We should be ready to do that. That's where we come in. We should be ready and continue working on all of this.
Yeah, Patrick, I think on your question of like, can you incorporate and price and pay for externalities? I think the biggest, long-standing problem is A, you always have this collective action problem, and B, is like, it's been incredibly hard to measure, right? And as a result of it, how do you price it, right? But I think there are 2 really positive changes that we're seeing. Is one is we're getting better at measurement. So as Stephen was mentioning, impact weighted accounts, this initiative by Harvard under Joe Seraphim, for example, I think is trying to do exactly that, which is like, can we actually establish a price? And this is going to continue to kind of keep us busy for the next 100 years of like, what's the price of a life? But I do think there's movement towards that and better understanding of how to disentangle the different effects. And as a result of it, I think you'll be able to measure it. And you have regulation. Regulation means ultimately that you need to be more careful around what you're saying and ready to actually invest some resource to comply to it. And I think both of it ultimately, whilst it's not an official kind of tax, it actually means if I want to be an impact fund and I want to write that on my website, I ultimately will have to comply to some law, which means I will actually have to make resources available and really spend time on that science and prove it to the regulator. So I do think implicitly we're moving that way, and I think that's extremely encouraging.
Thank you very much indeed. It's time flies when you're having fun. 60 minutes has finished. I begin by saying thank you. It's a heartfelt thanks to our speakers, Stephen and Stephanie. I'm pretty sure I echo the sentiments of everybody in the room that your contributions have been absolutely fantastic. I think we've all collectively shared and learned, and hopefully that will help advance the practice as well. My second thanks, of course, goes to everybody who has attended today. Thank you for your time, your energy, your questions. Amazing and interesting conversation. I always try to summarize the conversation, and I will not do it justice, I am sure. But I think it's fair to say that we all need to recognize that spectrum of finance, so the spectrum of impact as well, from investing with to investing for impact, and very much dependent on the mission of the investor. There's going to be a difference and the requirement for different types of capital. We have two optimists, 2 people whose glass remains half full, and I hope that is infectious for us all. But nevertheless, we identify what needs to be done. There is too little collaboration needed to scale impact. We need to redefine the playground. There needs to be some key ingredients, those pressure points. Regulation is required. And I think all of this is trying to encourage the movement, get us past that tipping point from risk mitigation and minimizing harm to a position of optimizing positive impacts. And to get over that tipping point, we can all do something. I like the idea of an old practice, but a new science. I often say impact management is old wine in new bottles, and we're getting better at measurement. I like the idea that we're on an innovation trajectory, and it is exponential. I started by saying, if not now, when? And I sort of feel like I want to finish by saying, if not now, when? We remain the front runners. We remain the pioneers. But we're preparing for that tipping point. And I think my final message to say is, in preparation for that tipping point, we will continue with this series of thought-provoking webinars. We have another one in June. And further preparation is, of course, the provision from the Efiko.Academy. We have options for autonomous learning and those who join as a social learner, part of a cohort. And we have some of our social learners with us today. Great to have you here. We have cohorts delivered in June and July in the summer, and those are appropriate times, no matter where you are around the world, be it Europe, the west coast of the States, where I am in Southeast Asia. So please do have a look at the website. I think in preparation for the tipping point, we all need to be better at that measurement and management piece. Once again, thank you ever so much. Thank you ever so much to our speakers, our panelists, everybody involved with today, and thank you to you. Wherever you are around the world, stay safe. Many thanks.